Okay, in this video, we're going to do something a little difficult. We're going to actually derive the statement of cash flows. So I'm going to start with a balance sheet. Believe it or not, I'm going to start with the balance sheet, and I'm going to end up with the cash flow statement. So if you understand the balance sheet, you'll be able to understand the cash flow statement. Okay, so and this is just, so let's take a look at the slide. And this is just to help in your conceptual understanding of how the cash flow statement is constructed. And so what I'm starting with is the balance sheet. Assets equals liabilities plus equity. And so this blue horizontal line represents the equals sign, because positive, if you take the positive number of assets, that should equal the number of liabilities plus equity. Okay, assets equals liability plus equity. So I put these plus signs in there just so you know what the sign is in front of these line items. Okay, the first transformation of this simple balance sheet that I'm going to do is I'm going to add a change symbol. So you can see I added a triangle to the beginning of these words. Triangle means change in, okay? It's called delta, okay? Delta assets equals delta liabilities plus delta equity. So another way to say this is since assets equals liabilities plus equity, it also must be true mathematically that the change in assets is equal to the change in liabilities plus the change in equity. Okay, that's just has to be true, right? If assets go up by 10, well, since assets equals liabilities plus equity, it must be true that changes in liabilities plus change in equity must be 10. Okay, it just must be true. So that's the first transformation that I've done. The next transformation that I'll do is I'll get a little bit more granular. So I'm going to break out assets into its components. So what could be the components of assets? And this is a small, simple company, just for example purposes. So this company has cash, accounts receivable, inventory, and PP&E. Okay, those are the 4 assets that this company has. And so the change in assets is equal to the change in cash plus the change in accounts receivable plus the change in inventory plus the change in PP&E. Now let's break out liabilities. And this company is going to have 2 different types of liabilities, accounts payable and debt. And so the change in liabilities is equal to the change in accounts payable plus the change in debt. Finally, equity. This company is very simple. It has just a common stock equity account and a retained earnings equity account. Okay, and so change in equity is equal to the change in common stock plus the change in retained earnings. So I hope you see that these relationships are still true. First, I just converted levels to changes. That's the first thing I did. The second thing I did was I just decomposed assets, liabilities, and equity into its components. So the components of assets, the components of liabilities, and the components of equity. Now let's move on to the next step. Okay, the next step, we're still going to have change in cash plus change in accounts receivable plus change in inventory. But now let's talk about this change in PP&E. So why does property, plant, and equipment change during the year? It had a beginning of the year balance and it had an end of the year balance. And you can think about the T account here, right? Why does PP&E increase? Well, we purchase new property, plant, and equipment. Why does PP&E decrease? Well, we depreciate PP&E and maybe we sell old property, plant, and equipment. So here I'm going to decompose the change of PP&E into equipment purchases, and you can think of that as net equipment purchases, like maybe we purchased some equipment and sold some equipment, and we're going to add just the net equipment purchases there, and we'll subtract the depreciation expense for the year. So the change in the PP&E balance from the beginning of the year to the end of the year, you take beginning PP&E plus equipment purchases minus depreciation, and you get ending PP&E. So I hope you see that it's fair for me to decompose the change of PP&E to equipment purchases and depreciation. And this is our first minus sign, right? Because depreciation reduces the book value of property, plant, and equipment. Okay. Now we'll talk about accounts payable, right? We'll just leave that the way it was, no changes there. We'll leave debt the way it was. We'll leave the change in common stock the way it was. But now we're also going to break out retained earnings. So why does retained earnings change from one period to the next? Well, retained earnings increases with net income and it decreases with dividends. So we've just decomposed the change in retained earnings into plus net income and minus dividends. So in other words, beginning retained earnings plus net income minus dividends equals ending retained earnings. And so this, all I've done here is decompose change in PP&E and change in retained earnings into the components that actually make up that change. Okay, let's move on to the next step. And the next step is actually a pretty simple step. We're just going to move the equal sign up to the top, okay? Because we want to solve for, in our cash flow statement, what we want to do is solve for the change in cash. So the cash balance changed from the beginning of the period to the end of the period. Why did it change, okay? So below the blue line is going to be the explanation of why the cash balance changed. And when you move the equal sign up here, well, something's going to happen to the signs in front of all of those asset accounts, right? They're going to flip. So when you move the equal sign, when you move accounts receivable to the other side of the equal sign, it becomes negative change in accounts receivable. When you move inventory to the other side of the equal sign, it becomes negative change in inventory. It's going to be minus equipment purchases and plus depreciation, okay? That's just because we moved those items to the other side of the equal sign, okay? This is just algebra. This is an algebra rule. But the things that just remain on the same side of the equal sign just remain with the same sign, okay? So the only thing we did was we just moved the equal sign to a different place and we changed the signs. And now the only thing we have left to do is just reorganize all of these line items into how they appear on the cash flow statement that you observe on public companies' financial statements. So what we're going to do is we're going to move net income to the top, plus depreciation after it, and then we're going to subtract changes in our assets. We're going to add changes in our liabilities. Then we're going to subtract equipment purchases, add change in debt, add change in common stock, and subtract dividends. So all I've done was I've reordered all of these same line items. They're still on the same side of the equal sign. They've just been reordered into the cash flow statement order. And now, actually, believe it or not, we're done. So I'll just apply some colors here, and I'll show you that when you take net income, you add back depreciation, you subtract change in operating assets, you add change in operating liabilities. That is the indirect method for the operating activity section of the cash flow statement. Subtracting, then remember this is net equipment purchases, so typically a cash outflow if companies do capital expenditures. That's just those are investing activities. And finally, any changes in the debt account or changes in the common stock account or payment of dividends, those are all financing activities. And you can see that now we've finished. That's it. We've derived the cash flow statement, and we started with the balance sheet relationship of assets equals liabilities plus equity.